We certainly are getting you geared up for what is going to be a very jam-packed week here on Wall Street. Consumer Price Index CPI data set to be released on Wednesday. Investors are hoping for some good news on inflation for the Fed to cut rates, and also earnings season, what Josh was just talking about, kicking off this week. Starting with, we're going to be getting Delta out on Wednesday, and then we're going to be hearing from some of the bigger banks. We've got Citi, JP Morgan, Wells Fargo, BlackRock, and State Street among the names of reporting before the bell on Friday. Now, last earnings season, nearly all of the larger banks posted a loss in profit as costs to attract deposits rose. Now, what can we expect this time around? We want to bring in Ohsung Kwon. He is Bank of America Securities, a senior US Equity Strategist. Great to see you here, Ohsung. Let's talk about this earnings season. How much of this growth that we are anticipating, how much of that do you think has already been priced into the market at this point?
Yeah, and thanks for having me today. Great to be here. Yeah, so we are still pretty constructive on equities market overall. And I think it's really going to be an earnings-driven market, as Josh was talking about. Price action is one thing, but at the end of the day, we need fundamentals to really support that price action. And we think we're going to get that. We are calling for 12% earnings growth for this year, followed by another 10% growth next year. So 250 on the S&P earnings for this year, followed by 275. And I think that's a great setup for equities. Companies have already cut costs, and we have been getting better than expected data, macro data, over the past couple of weeks, which supports that consensus might be too low, especially this earnings season, and we're looking for another strong quarter.
So if I hear you correctly, what we are expecting coming into this is actually a little bit lower than what we might get. I just note last year, I follow all the analysts very closely, and your team, along with Savita Subramanian, was among the most bullish, and you were proven correct at the end of the year. What gives you this, conviction about the strength of the U.S. economy that leads to these earnings that you're looking for to grow in such a way?
Yeah, and I think the macro setup overall is very, favorable for equities in general. The economy is still very strong. Inflation is coming down, and the Fed is probably done hiking as well. We are probably headed to an easing cycle later this year, and if that's the case, and earnings are inflecting higher. Earnings grew for the second straight quarter in Q4, and actually accelerated last quarter. And that started happening even without much demand recovery. And the reason why we were in an earnings recession was because cost was bloated, and that's been taken care of. Companies have, cut down costs, started focusing on efficiency. We started seeing evidence of that. The other reason is because of the shift that we saw from goods to services. And that matters because for earnings, half of earnings for the S&P is goods, whereas for the economy, it's only 20%. So the shift that we saw from goods to services, that was a major headwind for earnings. And that's one of the reasons why we saw an earnings recession when GDP was still growing above trend. We're starting to see that reverse. We saw the ISM PMI coming in above 50 for the first time in like 17 months when the services PMI missed. So if the dynamics between goods and services starts to normalize, that's good news for equities, for earnings and fundamentals.
So talk to us just about, when it comes to Bank of America, your team's base case right now, you have made the case, at least in the latest note here, that it doesn't really matter whether or not the Fed actually cuts in terms of the movement that we could see, that upside movement that we could continue to see in the markets. Why? Walk us through that thesis and why that essentially makes sense.
Yeah, at the end of the day, it's really earnings. And if the Fed can cut less because the economy is still strong, and as a bull, I'd rather much see the Fed cutting less because the economy is very strong than the Fed having to cut because the economy is weakening. And I don't think it's really about when the Fed starts cutting. I think it's really about how. Whether it's proactive first cut or reactive first cut. If it's a proactive first cut, meaning, the Fed starts cutting for insurance reasons, that's obviously bullish for equities. But if it's a reactionary first cut, the Fed having to cut due to weakening data, that's bearish. And as a bull, I'd rather much see, the economy continues to do better, and the Fed, staying more or less dovish.
Ohsung Kwon, we really appreciate you taking the time joining us here in Yahoo Finance. Look forward, hopefully, having you back soon. Bank of America Securities Senior U.S. Equity Strategist. Thanks, Ohsung.